Hello, Optuma users, and welcome to this sixth video in the educational series from GoNoGo Charts. My name is Tyler Wood. I'm a CMT charter holder, and today, as always, I am joined by Alex Cole. How are you doing, my friend?
Very well, ready to tie up all the loose ends.
That's right. That's what we're doing today with this last video. We're going to tie together all of these pieces. We've discussed some big picture concepts, and we're going to talk a little bit about an evidence-based investment process and some research practices you can use ahead of your security selection and trade decision making. So let's dive right in. Quick refresher, all the way back to video number 1. We talked a little bit about this gentleman, John Henry. He's familiar to you if you've read the book or seen the movie Moneyball. He's a very accomplished trend-following investor. And what this quote is telling us is that we need to focus on what actually is happening, right? We need to quantify and listen to the message of the market rather than introduce our own narratives or what we think should be happening with the world of investing. And so divorcing ourselves from those narratives or what we think we believe, separating ourselves from the emotional impact of our own human biases is really the practice of technical analysis. And so we talked a lot about a rules-based checklist, using lots of tools to get a sense of the weight of the evidence when we're making trade decisions. But of course, this can lead to some problems with the field of technical analysis. And that is that when we add too many indicators to our chart, we can introduce analysis paralysis, or what we were talking about with that John Henry idea was we start to reintroduce our own biases or our emotions to the trade decision-making process. Because if there's enough squiggly lines going on in your chart, you can convince yourself of just about anything, right? Are all of the steps of my checklist being met? Well, I'm going to wait a little bit longer to get out of this trade because I really think it's going to come back, and I don't have conclusive evidence from everything that's going on in my chart. That's what we want to avoid. But we do want to capture all of that powerful information from these incredibly robust and incredible tools that the innovators of technical analysis have given to us in this field. So, Alex, let's talk a little bit about the complete solution from GoNoGo Charts that does just that.
Yeah, absolutely. And it really stems from the fact that we want to keep our analysis as deep as possible, but as also as simple to understand as possible. And of course, it started with the GoNoGo trend, video number 1, where we blend objective foundational concepts of trend identification into an indicator that just colors the price action according to the trend strength. So that way price remains the focus. We can see what's happening underneath price in terms of market dynamics, areas of supply and demand, but we've got that complete understanding of what the trend is doing at any time. Moving on from there, we talk about momentum analysis, and we do the same thing with our GoNoGo oscillator. We blend several of the most robust momentum tools into one indicator that gives us what we need from momentum analysis. We get a sense of overbought and oversold. We get a sense of divergence analysis, but we also get an understanding of using momentum in a trend, because remember, we introduced the importance of having an objective level, and that's our zero line that can be used as support or resistance depending on the trend. And then the interaction of the oscillator with that zero line and with the trend leads to our discussion of the GoNoGo icons, where we were able to sort of talk about the importance of data visualization, of drawing our attention to those important moments where something interesting was happening in terms of oscillator or trend. And then, of course, the last piece of the puzzle for us was to include a sense of volatility, specifically reduced volatility. We want to look at areas of compressed price action, because we know that from reduced volatility can come high volatility moves. And so we do that by building the grid of the GoNoGo squeeze for every bar that the oscillator stays at zero, right? Super important to know when the oscillator is at zero. So we highlight that with the climbing grid of the GoNoGo squeeze. And then, of course, whichever direction we then see the break out of that squeeze will help us understand the likelihood of price's next movements.
So you've been with us through 5 educational videos covering some big picture concepts in technical analysis. What we want to do in this video is bring it all back together to the very simple 3 questions that we need to answer for any security on whatever time frame you're trading across all asset classes. And from these 3 simple questions, we can make our trade decisions. So the first one is, where is the trend at, right? Direction and strength of those trend conditions. The second question is, where is our go-no-go oscillator at, right? High, low, are we at the zero line? Do we have heavy or light volume? And then that third question, is there anything important happening in terms of volatility? Is the go-no-go oscillator approaching or resting at the zero line? So Alex, let's bring this to life with a few examples, starting with a chart of Caterpillar.
Absolutely. So do it with us. Shout it out at home. Nobody can hear you or see you. What's the trend? Question one. What is the trend? Well, the trend is a go trend. We are in a go trend. We're seeing that we are painting weaker aqua bars. So we're in a go trend, but we're seeing a little bit of weakness as price pulls back from its recent high. Where's the oscillator? The oscillator is at a value of 1. So there's some slight positive momentum behind the go trend that we're seeing in price. Is there anything important happening at the zero line? Well, only in that we are close to zero. So we're going to watch to see if it finds support at that level, if it hits zero.
Absolutely. Let's move on to another example.
The
This
next one, I
time,
believe, is NVIDIA. So NVIDIA is a different picture. We saw a very strong go trend in place with that oscillator primarily finding support at the zero line throughout that whole time frame. But of late, we've seen a trend change. You can see where is the trend? Well, the trend right now is painting an amber bar. Remember, our amber bars are our bars of uncertainty, often found in transitionary periods between trends, often found when there's uncertainty in the markets. That's the idea that it's better to go fishing and stay out of trading if the indicator is not telling you that enough criteria have been met to find a trend in either direction. So what's the trend on NVIDIA? We're in a go fish area of neutrality. Where's the oscillator, though? The oscillator is in negative territory. And we can see that it just recently broke out of a squeeze that was approaching its max. So if we were to sum up this picture, we could say the go trend has ended. We're seeing trend change. We painted a no-go bar, but now we're back to that uncertain amber. Negative momentum, though, which is certainly indicating that there's more selling than buying as we see the fluctuation of the trend colors. And of course, volume is heavy as well. Remember that the darker blue on our oscillator gives us a sense of volume. When it turns to dark blue, that's heavy relative volume. So the beginning of some change for NVIDIA. If we move on to another one, I think the next one is going to be Meta. And Meta has been just a phenomenal stock for so many people who've been really reaping the rewards of this explosion in growth securities of most of this year. Meta's been a leader there. So let's do the three questions. Let's keep it simple. Where is Meta in terms of its trend? It's in a go trend, but it's painting a weaker aqua bar. So similar to what we saw on the chart of CAT. It's come off recent highs. We can see that because there's nothing else on the chart to sort of complicate our view. We can see that we made a higher high, and we've fallen away from that, and we're showing some weakness as the trend indicator paints weaker aqua bars. Where are we in terms of momentum? Well, momentum is at zero. We know the importance of the zero line from our discussions in an earlier video. And this tells us that there's a real tug of war happening here between buyers and sellers. So as price corrects from its high, we're looking to see in which direction the squeeze will be broken. We know that for every bar the oscillator stays at zero, the squeeze grid climbs, and that shows us an extended period of reduced volatility. So it's going to be very important to see whether Meta can continue in this trend. If the oscillator stays in positive territory, we'll see trend continuation. If it doesn't stay in positive territory, then of course that's a threat to the go trend that we see in Meta. And I think we've got one more example. This chart is the chart of Carvana. And Carvana, you can see, also been in a strong move higher, but has come away from its highs as well. So real quick, question one, what's the trend? The trend is a go, painting weaker aqua bars as price corrects from its high. Where's the oscillator? The oscillator is at a value of -2. So there's some negative momentum, which of course is not healthy for a go trend. So we're seeing weakness in the go trend. We're seeing negative momentum. Anything important happening around the zero line? Only in that it recently broke through the zero line into negative territory. So we know from our discussion of momentum that if the trend is healthy, the oscillator should find support at zero. it didn't. So that might be some cause for concern for people that are still hanging on to that go trend.
Absolutely. So a lot of these examples look to be long only biased. And we know that a lot of you out there also play to the short side. And so what we wanted to do with GoNoGo Charts is provide a complete technical picture. Very easy to understand with the checklist already built in, heavy computation happening in the background. But for you individually, you're going to make your trading decisions and your rules based off of your own risk tolerance, your time horizon, and your general objectives. So for many investors, after a long go trend, a break of the zero line might be enough for them to reduce position size or exit altogether. And what we're going to talk about in the second half of today's video is a little bit of the analytical approach that we take at GoNoGo Charts, learning from the best technical analysts that Wall Street has ever churned out. So we're going to take a top-down approach, and we're going to talk about a concept called relative strength. Every one of these charts has been the absolute trend of price action on an individual security. But what we can use our technical tools to tell us is also a comparative study on how an individual security is performing against others. We can look at sector groups and indices. So let's just dive into this idea for a moment. We're pulling this quote from Martin Pring, the veteran money manager, author, and world-renowned technical analyst. Now, many others have built on this concept of relative strength. You might be familiar with relative rotation graphs and other incredible data visualization tools. But the basic concept is that we're simply using a ratio chart. We're dividing one security by another to give us a sense of how that trend is performing relative to a benchmark or to another security that we might select. So, as with everything technical analysis, a picture is worth 1,000 words. So let's just talk about styles first. If we were to look at growth equities versus value shares, right? And if we were to compare growth versus value, we could pop up two charts and take a look at both lines side by side. Now, if we were to just eyeball these two styles, we can see that growth equities were performing well coming into the COVID-19 collapse. So this is February and March of 2020. We saw a collapse, and then they took off again and kind of rolled over into 2022. Eyeballing the value shares, we can see that the lines look very similar. Again, collapsing in early 2020, rallying off those COVID lows and that V bottom, and then tapering off into 2022. So maybe we notice there's a little differentiation here in 2022, but this is very subjective. It's only useful in hindsight. And so what we need is a relative strength line that's simply going to divide growth over value. And that's going to look like this. So this third panel is showing us the relative strength of growth over value. Now, what's fascinating, what John Henry will tell you, is that the market knows everything that we know, everything that we think we know, and all the things that we don't even know that we're missing, right? Now, if we look at this relative strength line, we can see that growth shares started to outperform value ahead of the COVID collapse, right? Growth started outperforming value shares before the indices turned over. The other thing that we notice is that this relative strength line increases, right? We're strengthening to the upside, growth versus value. Yes, on an absolute trend basis, they are both in downtrends or in no-go territory during that collapse. But the relative performance of growth over value tells us that growth was losing less, right? Moving down at a lower velocity than value shares were. Makes sense, right? The stay at home, everything's been shuttered in the interest of public safety. Those value shares that are typically tied to more cyclical and industrial complexes, our growth equities played the day for that stay at home trade. We can also see in this relative strength line that there's a period of outperformance, some fluctuation, value leading growth for a time in early 2021, taking off again, and then that relationship reversed in 2022. Now, what's important to us at GoNoGo Charts is not just the movement of that line, but the trend conditions of that line. So we could apply the same concept of GoNoGo Charts to relative strength ratios to help get us a better sense of trend and direction looking at these ratios. So I'm just going to switch over to a complete GoNoGo chart for this same relationship on a weekly basis between growth and value. So this was us coming to the end of 2021. We saw that relationship reverse, growth underperforming value, some counter trend rallies, but in a no-go trend. Value shares outperforming growth throughout 2022. And here we got into 2023, the relationship reversed again, and we see outperformance from growth shares over the value counterparts. Now we're just using a pre-built index from the S&P 500, SPYG versus SPYV. Now that go trend in growth versus value is in a strong go condition on these weekly bars. We are also seeing the GoNoGo oscillator resting at the zero line, meaning that that relationship is now in a period of a little bit of indecision from momentum. We've got a volatility compression. We're building a GoNoGo squeeze. And so we're going to watch for the direction of this break to understand our allocation principles on growth versus value shares and whether or not this trend can continue higher. So let's do a couple more relative strength charts, Alex, as we look through this top-down approach.
Yeah, as a very similar idea here, using technology and utilities also to give you a sense of growth versus value and how to position yourself from an asset allocation standpoint. And you can see that the trend has been this year, for much of this year, has been an outperformance of technology relative to utilities. You can see that that ratio is in a go trend. You can see that we are weakening. We've had a little bit of weakness as the aqua bars are being painted after that most recent high. And you can see the oscillators approaching the zero line. So just the same process. Question one, what's the trend? Trend is a go, but it's weak. Where's the oscillator? Oscillator's at 1, which is some slight positive momentum. Is there anything interesting happening at the zero line? We've got the oscillator fast approaching 0. So we will watch to see if this trend of outperformance, the go trend of technology versus utilities, is likely to continue. And of course, we know that if the oscillator finds support at the zero line.
So we can compare various sector groups. We can also look at the relative performance of any sector against the benchmark index. A lot of institutional portfolio managers care deeply about their relative performance, and they're benchmarked against large equity indices. So in this case, we're looking at the energy sector versus the S&P 500. And we can see that energy on this daily chart has been tearing to new highs on a relative basis, outperforming the S&P 500 index. So we're in strong go territory. That's the trend condition for the energy sector, the XLE, versus the S&P 500 index. How about the GoNoGo oscillator? Here we have strengthening positive momentum on heavy volume. We've just touched overbought territory, and we're coming back to a positive level 5 momentum. So we see a little counter trend correction arrow on the top of the price panel, but we're seeing the energy sector outperforming the S&P. So when we think about our analytical approach, we can take a top-down perspective. We can look at style groups. We can compare sectors to one another. We can compare sectors to the industry benchmark. And then, of course, Alex, we could also look to individual securities. So you might look within a group that you really want to participate in and compare two names within that same sector or industry group. For illustration purposes, we love looking at Cisco versus Cisco. And no, we're not talking about the rappers. We're talking about computer networking and cybersecurity versus paper products.
Yeah.
So Alex, walk us through this chart.
Just to keep that idea of sort of growth versus defense, I suppose, right? We're looking at Cisco, of course, the technology company, versus the paper products company that make toilet paper. You can't get more defensive than that. We were all there during the pandemic, COVID crash, toilet paper exploding in terms of sales. But right now, what are we seeing? We're seeing that Cisco, the technology firm, is in a relative go trend to the utilities commercial paper product company, also Cisco. So relative outperformance, where's the trend? It's a strong go. Where's the oscillator? The oscillator is at 4, so approaching overbought territory. Anything interesting happening around the zero line? We've just found support at that zero line. We've retested it, bounced back into positive territory, and we can see that volume is becoming heavier. So a strong trend of outperformance when you compare these two securities together.
Absolutely. So thank you all, Optuma users, for tuning in with us to this 6-part educational series from GoNoGo Charts. We hope that you've watched all of those in chronological order. If not, head back and dive into some of the earlier videos for some deeper dive discussions of these high-level concepts in technical analysis. As always, if you have any questions for Alex or I, you can shoot us an email, info@gonogocharts.com, or check out some of our subscription research on our website, as well as we take that top-down approach across the asset classes, through the sector groups, and down to individual securities. Until we meet again, hope you take care of each other and trade them well.